Hello, my name is Paul Marriage and welcome to the HI European Market Neutral monthly video update for September 2021. September, quite a challenging one again out there for markets. I probably don't need to tell you how many things spooked global markets in September, but I guess we started with the Evergrande issues in China and the risk around their debt and generally that whether that would create a sort of financial crisis 2 situation in China. Seemed to be managed by the Chinese government. No surprise there, perhaps. But then after that, we had a number of probably not particularly fantastic bits of macro news around the world where we saw some of those trends that people are worried about. The inflation costs generally across the world with wage inflation, raw material cost inflation, labour shortages. We hear a lot in the UK about fuel shortages, the energy price spike, and driver shortages, a lot of things that together make for a pretty grumpy consumer, which generally makes for a pretty grumpy end markets. And I think some of those issues that we hear about a lot in the UK, energy, food and fuel crises, are actually quite widespread across most global markets and definitely in Europe as well, as markets reopen. So that was a pretty ugly background for markets, which clearly had been pretty good. I mean, indices have had a very good year to date this year. So a give back period for global indices perhaps wasn't surprising. So we're delighted to have made a small positive return, albeit one which was a bit of a Matterhorn. We made a lot of money in the first half of the month and we lost nearly all of it in the second half of the month. So overall we made a positive return, but we didn't really make it in a way that I guess we can be proud of in that we did pretty well and then we gave it back. So also within that, we should also look at the fact that European markets were generally weaker than UK markets. UK indices held up better. The energy weighting particularly helping UK indices as oil stocks rose on the back of that tighter energy market. However, in the UK, we also saw mid caps and smaller caps much weaker than larger caps for the same reason, a broader market. So UK mid and smaller caps behave more like European indices. It was really rather UK large cap that held up a bit better. So we need to kind of understand those dynamics a bit when we look at the month as well. So what were the underlying stories for us in there? So we did have some winners, and you'd expect a fund that had a good start to the month to have had some winners. And I think the sort of standout names were things like Jet2 in the UK, where travel was reopened. And if we go back to a kind of normal holiday environment for UK tourism, then UK airlines and UK holiday-based airlines like Jet2 should have a good year next year. These are cheap, well-funded stories, so I can see the attraction there, and perhaps the reason why those stocks, had a pretty decent recovery during the month. Elsewhere in Europe, we did very well out of the Vivendi Universal Music demerger. That was a good piece of early research and some unlocked value there, which we benefited from. So that was a good trade for us through the month, and in actually a reward for some pretty sensible research work done on that. Clearly, we had the usual challenges in a falling market of a number of favoured ideas not doing so well. But actually, if we look at the worst performers in the fund, it is good to see that the shorts do stand out. Things like CMC Markets, Luceco in the UK, Software One Group in Europe, all weak shorts during the month, which was good. Where our pain came fundamentally was some of those more growthy, more defensive things that had done well for us in the summer and have been, a strong drive to the performance really did roll over again. So you'll be bored about hearing about growth to value rotation again, but it's clearly a massive theme in Europe, and hard as we try to take ourselves out of that a bit, we ended up with a portfolio which was probably too growthy mid-month. So it was, some of those stocks came back pretty sharply in the second half of the month, and some of them we've moved on, some of them we've retained. So a combination of some good trades, some good ideas in Europe like Vivendi, Total, the energy stock, well placed there, and in the UK, Jet2, Dunelm. Dunelm's interesting because it was a physical bricks and mortar retailer, and it's now become omnichannel, and it's done a really good job of that, and we've had good upgrades likewise next. So really interesting going on in e-commerce in the UK, and I think we'll probably see this in other markets where actually the traditional retailers that are converting are doing better in a post-pandemic reopening phase because they've got physical and they're quite good at online now. than the pure online players, who probably saw a bit of a dip in early summer and are now really struggling with some of those supply chain issues, with a much more of a just-in-time model, much more reliant on perhaps imports and warehousing. And so the website and the warehouse type model being a bit challenged right now, which is interesting and should give us good opportunities as well. So, a difficult month in terms of we've had a really strong period for this fund, and while this month, is a positive one, and then it's a positive one against tough negative markets, which is good. It's been a difficult month to manage because we had some very strong momentum which we've given back a bit. Clearly we go into Q4 having got through that kind of fairly tough period, and strategy remains very much intact. And I think we go back on the bike. I think that one of the most important things remains for us not to get dragged into the growth and value debate, just to keep picking stocks. And where we've done well this month has been stock picks rather than the macro views. So being lulled into a too growthy portfolio is probably a lesson as we enter a period where maybe some of those growth stocks, again, like we've had before in the last 18 months, and we had a little bit earlier in this year, we have a little bit of a rotation towards value, and there's still plenty of value out there, across markets, and things like energy could run a bit, and the energy tightness is something which we think could be here to stay at least into the winter. So, interesting month, pretty challenging time to be a fund manager. Wasn't that much fun. We fought pretty hard. We've ended up just about on top. We remain pretty positive about the prospects going into Q4. There's a lot of noise around, domestic demand. There's a lot of noise about some of those macro issues we mentioned up front. But we equally look into 22 thinking that, that there's some pockets of pretty sensible valuation. And we don't meet many company management teams who aren't relatively positive about the prospects for next year. So, we don't worry ourselves too much about some of the challenges we faced this month. We're pretty much focused on the next month and the next quarter, and ultimately the next couple of years as we continue to build a strong record in the strategy. Thank you.